It's funny how we're told money is complicated, right up until someone wants us to sign something we definitely shouldn't. Somehow, the richest people keep getting richer, and the rest of us get advice. And trust me, this rabbit hole gets dumber. 1. Watching a banker explain compound interest to a teenager is like watching someone try to sell a haunted timeshare. There's enthusiasm, there's paperwork, and there's a strange confidence that no one will read the fine print. The lie begins with the classic promise that interest is your friend, a loyal golden retriever that grows your savings while you sleep. What they skip, of course, is that the same golden retriever turns into a taxidermied wolf when the bank applies compound interest to your credit card debt with the efficiency of a vampire billing by the minute. They frame it as a magical financial fertilizer, ignoring the part where missing one payment transforms your balance into a supernatural entity that grows whenever someone whispers the word APR. The entire system runs on pretending compounding works equally for everyone, when in reality it functions like a buffet where the wealthy own the restaurant and everyone else is just allowed to smell the breadsticks. But bankers adore this myth because it keeps people hopeful, confused, and quietly paying interest until the sun burns out. 2. There's a timeless illusion that your bank account balance is a sacred truth, a number backed by marble columns, vault doors, and the silent authority of men in suits. Yet the entire thing is basically a polite hallucination maintained by a server rack humming in a basement that floods every spring. The myth that money physically sits in your account like a goldfish in a bowl is one of finance's greatest comedy sketches. Banks lend that same dollar to 12 different people, use it as collateral for loans that fund more loans, and then congratulate themselves for stability while telling customers to stop buying lattes if they're broke. If people truly understood that their money is a digital suggestion that banks treat like a prop in a school play, the entire industry would collapse faster than a toddler's Lego tower. But bankers keep everyone loyal by offering sleek apps and the occasional free pen, hoping no one asks where their actual dollars are. Spoiler, nowhere you can visit without a subpoena. 3. The old slogan promising that cash is king continues to strut around the economy wearing a crumbling paper crown, insisting it still runs the kingdom while digital payments laugh behind its back. The lie banks love is that physical cash gives you control, independence, and sovereignty, as if holding 20 crumpled dollars makes you a financial warlord. Meanwhile, the same institutions quietly push cash into extinction by charging fees for ATM withdrawals, closing branches, and expanding card networks until swiping a piece of plastic feels like a civic duty. The irony is delicious. Bankers encourage nostalgia for cash the same way an antique store romanticizes telegraphs. They want people to believe cash provides freedom while simultaneously funneling everyone toward systems that track every purchase with the precision of a nosy neighbor armed with binoculars and free time. The whole narrative survives because it sounds empowering, even though the only thing cash truly dominates is the gap between your couch cushions. 4. The myth that buying a house is the ultimate sign of financial maturity hangs over society like a motivational poster, purchased by someone who hasn't made a mortgage payment in 2 decades. Banks adore this lie because it transforms a 30-year debt sentence into an inspirational milestone, something to celebrate with Instagram pictures and earnest captions about building equity. The funniest part is how lenders present mortgages as opportunities, as if they're handing out golden tickets instead of shackles that adjust their grip with every interest rate change. People are told renting is throwing money away, while somehow paying hundreds of thousands in interest is framed as a noble investment in one's future. The entire system depends on convincing people that achieving adulthood means willingly signing documents longer than a fantasy novel and agreeing to pay property taxes until the earth cools. Banks don't just love the lie, they rely on it the way vampires rely on dim lighting and gullible visitors. 5. Nothing beats the classic financial fairy tale that credit scores are objective, rational measures of responsibility, carefully calculated with scientific precision. In reality, a credit score behaves more like an emotionally unstable roommate, unpredictable, moody, and capable of tanking your future because you forgot to pay a $19 bill 3 years ago. Banks promote this myth because it gives them the authority to play celestial judge over who receives loans and who must be banished to the land of secured credit cards. The scoring algorithms operate like mysterious priests guarding an ancient temple, except the priests are corporate software engineers who refuse to explain why paying off debt too quickly sometimes lowers your score. The absurdity peaks when someone's credit tanks simply because they checked it too often, as if curiosity itself is financially suspicious. Yet banks maintain the illusion of fairness because the myth keeps people obedient, fearful, and doing whatever it takes to appease the almighty three-digit deity. 6. Few lies have survived with as much smug confidence as the idea that banks exist primarily to help people, a phrase printed in brochures with the sincerity of a cat promising not to scratch the furniture. The origin story bankers love to tell is that they safeguard dreams, empower communities, and nurture small businesses, while reality shows an institution that charges fees for not having enough money, which is roughly the opposite of help. This myth thrives because it's wrapped in soft language and warm lighting, usually featuring stock photos of smiling families who definitely don't know they're being used to sell overdraft penalties. The joke is that every helpful service comes with terms so predatory they should be narrated by a nature documentary presenter explaining how a spider traps flies. Banks promote this wholesome fantasy because it conveniently distracts from the fact that their profit model revolves around weaponizing inconvenience. Helping people is merely the costume they wear to the annual shareholder masquerade. 7. The idea that the stock market is where wealth is built is one of finance's most theatrical illusions, maintained through years of glossy graphs and motivational quotes about courage. Banks adore this myth because it convinces ordinary people to toss their savings into a casino disguised as a business seminar. The system relies on treating volatility like weather patterns, unpredictable yet somehow noble, while ignoring that the entire structure can wobble because a billionaire tweeted something cryptic at 2 a.m. People are told to think long-term, which is convenient advice coming from institutions that panic if the market sneezes. The stock market is less a place of wealth creation and more a digital roller coaster, where the wealthy sit in the front car sipping champagne while the average investor holds on to their lunch and prays the track is actually attached. Banks uphold the myth because without it, most people would realize they're funding a thrill ride they never asked to board. 8. The widely accepted belief that budgeting is a foolproof path to financial freedom deserves an award for comedic optimism. Banks love this myth because it convinces people that the universe follows spreadsheets, ignoring the tiny detail that life behaves more like a malfunctioning slot machine. Advice columns frame budgeting as a magical shield that protects against chaos, pretending that rising rent, medical bills, and impulsive snack purchases are all problems solvable by color-coding expenses. The absurdity heightens when financial institutions offer budgeting tools that track spending with the cheerfulness of a kindergarten teacher while quietly recommending credit products that undo the entire exercise. Budgeting is useful, sure, but presenting it as the golden road to prosperity is like claiming an umbrella can stop a hurricane. Banks benefit from the myth because it subtly implies financial struggles are personal failures rather than systemic inconveniences engineered by industries that profit from desperation. 9. The belief that retirement accounts guarantee a comfortable future has been sold so aggressively it may as well come with a jingle. Banks adore this myth because it lets them market long-term investments like enchanted treasure chests that only grow, never shrink, and definitely don't get devoured by stock market tantrums. People are told that consistently contributing, even during economic crises, will eventually produce a nest egg large enough to retire on a beach, sipping something with a tiny umbrella. The truth is that retirement accounts behave like temperamental houseplants that require constant monitoring and occasionally burst into flames during recessions. The fine print usually includes penalties for touching your own money, which is a hilarious concept. Apparently, funding your life early is irresponsible, but paying fees is character building. Banks keep the dream alive because without it, people might ask why the golden years depend on decades of feeding financial institutions like obedient zookeepers. 10. The myth that debit cards are the safe alternative to credit is a delightful piece of propaganda that banks treat like gospel. People are told debit cards protect them from overspending, as if the card jumps out of your wallet and smacks your hand every time you approach a sale. What they don't mention is that losing a debit card is like losing the key to your house. Someone can stroll in and financially redecorate your life before you even notice. Fraud protections for debit are notoriously slower, and meanwhile, your actual money vanishes like a magician's volunteer. Banks promote the safety narrative because it nudges people into believing they're making responsible choices while still leaving them vulnerable enough to consider credit for emergencies, a phrase that essentially means when the bank wants to earn interest from you. Debit cards aren't safer. They're just less dramatic, like a villain in a movie who whispers instead of monologues. 11. One of the more charming financial myths insists that banks waive fees out of generosity, as if they're benevolent monarchs occasionally blessing peasants with acts of royal mercy. The truth is that fee waivers are calculated theatrics. Banks impose outrageous penalties and then graciously remove them to appear magnanimous while still conditioning customers to accept the existence of those penalties in the first place. It's the economic equivalent of someone punching you in the arm and then handing you an ice pack with a smile. The lie persists because fee reversals feel like small victories, even though they're simply strategic refunds offered to preserve loyalty. Bankers adore this dynamic because it transforms customers into grateful petitioners, relieved rather than outraged. It's an elegant psychological trap, one that ensures the institution remains the hero of a story it created by causing the original problem. 12. The belief that financial advisors provide impartial wisdom belongs in the same folder as fairy tales about magical beans. Banks love the illusion that advisors act as objective guides, helping people navigate the wilderness of wealth with the calm authority of seasoned explorers. In reality, many advisors operate like commission-powered tour guides, leading customers through a curated gift shop where every product just happens to benefit the institution. The myth thrives because the presentation is immaculate: crisp suits, framed certificates, and vocabulary dense enough to discourage questions. Clients walk away feeling enlightened, unaware that their financial roadmap was assembled with all the impartiality of a restaurant menu that only lists dishes the chef likes. Banks keep this myth alive because trust is profitable, and nothing builds trust faster than giving advice while standing in front of a mahogany desk. 13. The old mantra that saving money is easy if you're disciplined continues to haunt modern life like an outdated meme that refuses to die. Banks adore this myth because it places the burden of financial struggle on individuals rather than on the systems designed to siphon money with surgical precision. The narrative ignores wage stagnation, inflation, and the helpful rising cost of everything except people's paychecks. Instead, the public is told that skipping avocado toast or brewing coffee at home will somehow transform their bank accounts into fortresses of wealth. The absurdity lies in pretending discipline can outsmart rent hikes that appear like horror movie jump scares. Banks cling to the myth because it maintains the illusion that success is solely a matter of effort, neatly absolving institutions of any responsibility. It's a comforting story, until basic living expenses ambush your budget like gremlins with calculators. 14. The myth that high risk equals high reward is treated like an immutable law of nature, as though the universe itself guarantees payouts to anyone reckless enough. Banks adore this narrative because it encourages people to pour money into volatile assets with the enthusiasm of contestants on a reality show. The phrase conveniently omits the part where high risk also equals catastrophic loss, which financial institutions witness from a safe distance while sipping coffee and adjusting their fee structures. The myth survives because it flatters the adventurous spirit, presenting recklessness as bravery instead of what it often becomes: a fast track to watching your balance shrink like a sweater in a boiling wash cycle. Banks rely on this selective truth because the more people gamble, the more institutions profit from the transaction fees, advisory cuts, and comforting lectures that follow. 15. The widespread belief that banks freeze accounts for your protection deserves an award for comedic misdirection. In practice, account freezes operate like automated panic attacks triggered by algorithms that interpret normal human behavior as suspicious. Try making a large purchase, traveling suddenly, or simply existing near an unusual zip code, and your account may lock itself faster than a paranoid raccoon guarding its trash. Banks promote the narrative of heroic intervention, pretending they're shielding customers from villains when half the freezes occur because someone bought groceries in 2 different neighborhoods. The myth survives because the alternative is admitting the systems are glitchy, inconsistent, and powered by risk models that would fail a high school group project. Banks rely on the protective illusion because it reframes customer inconvenience as noble sacrifice, letting institutions claim victory each time they inconvenience someone into financial paralysis. 16. Watching banks pitch free checking is like watching someone offer a free puppy and strategically forgetting to mention the lifelong medical bills. The account looks adorable on paper until the first overdraft fee lunges out like a raccoon defending its favorite dumpster. The myth survives because the word free triggers the same optimistic glitch in the human brain that makes people believe they'll fold laundry right after the dryer finishes. The truth is that the account is free only if you obey a labyrinth of conditions: minimum balance requirements, monthly deposit quotas, and maintenance rules that feel like a scavenger hunt designed by a bored bureaucrat. Miss a single requirement, and suddenly the account unleashes $10 penalties with the enthusiasm of a game show host awarding consolation prizes. Yet banks keep the word free printed everywhere because it works. People never question why something free requires a contract longer than a fantasy novel and the vigilance of a medieval sentry guarding a castle gate. 17. The classic promise that money in a savings account grows over time needs its own comedy special, mainly because the interest rates often grow slower than a houseplant watered exclusively with hopes and compliments. Banks push this myth with the same gusto as fitness influencers selling miracle shakes, ignoring the tiny detail that the average savings rate barely keeps pace with a bored snail on a leisurely stroll. The pitch always sounds heroic. Place your money here and watch it multiply, even though multiplication in this context means earning 17 cents a year while inflation eats $20 from the other side. The irony is spectacular. People are told to build emergency funds in accounts that lose value every time the economy sneezes. But banks adore this myth because it convinces customers to store cash in places convenient for the institution, not the customer. It's a brilliant system, just not for the saver, because the only thing that truly grows is the bank's access to your deposits. 18. The belief that banks review loan applications with careful human judgment might be the funniest lie in modern finance. The real decision is made by algorithms so emotionally detached they would reject a firefighter mid-rescue for insufficient credit diversity. People imagine solemn committees studying their life story with compassion, when in reality the software handles everything with cold efficiency, treating applicants like digital trading cards. The system evaluates your worthiness based on bizarre criteria, weighting things like your longest opened credit line as if it were a meaningful personality trait. Banks maintain the illusion of personalized review because it sounds trustworthy, even though most decisions happen faster than a pop-up ad. The absurdity becomes more apparent when someone with perfect payment history gets rejected because they closed an old account, triggering the algorithm's version of a tantrum. Yet the myth persists because banks know telling the truth would sound horrifying. Your financial future depends on a machine that panics if you behave like a normal adult. 19. The idea that paying off your car loan early is universally wise remains one of the industry's most successful practical jokes. Banks encourage responsibility while quietly burying clauses that penalize early repayment, treating financial diligence like a mischievous offense. People dream of clearing their loans ahead of schedule, imagining applause and confetti, only to discover fees hiding in the contract like tiny legal ninjas waiting to spring from the shadows. The explanation offered is always laughable. Early repayment disrupts the bank's expected interest stream, which is a delicate, poetic way of saying they're sad you stopped letting them harvest your paycheck. Banks maintain this myth because it motivates people to pay faster, while still allowing the institution to profit from the fine print no one reads. It's a scheme so elegant it could be displayed in a museum. The illusion of empowerment paired with the reality of punishment for being too responsible. 20. The notion that banks round up transactions for savings as an act of kindness belongs in a fantasy realm where unicorns file taxes. The feature is presented with wholesome charm. Every swipe magically transfers spare change into your savings, as if the bank is teaching you financial discipline through adorable micro-habits. What they don't highlight is that the system conditions people to swipe more frequently, turning every impulse purchase into a tiny savings event, which is a marketing triumph so bold it almost deserves respect. The bank wins twice. They collect transaction fees while convincing customers they're doing something virtuous by buying fries. It's a psychological sleight of hand, spending framed as saving, ensuring everyone feels financially productive while actually emptying their accounts. Banks love the myth because it's the rare trick that makes people grateful for the privilege of being manipulated with the gentleness of a parent encouraging toddlers to eat vegetables shaped like dinosaurs. 21. The claim that online banking is faster, easier, and more reliable feels like the punchline to a joke told by someone who has clearly never witnessed a digital platform collapse during payday. Banks promote this myth relentlessly, usually while quietly dismantling physical branches, until customers are forced into a digital maze where every action requires 3 passwords, 2 security codes, and the patience of a monk. The platforms are presented as sleek and modern, yet behave with the fragility of a paper airplane in a thunderstorm. Try transferring funds during high traffic hours, and the system responds with all the confidence of a nervous intern. But banks cling to the myth because it reduces staffing costs and shifts blame onto user error whenever the software malfunctions. It's the perfect equation. Customers do all the work while the bank marvels at its own innovation, pretending that a loading spinner is a feature rather than a cry for technical assistance. 22. The idea that financial literacy courses offered by banks are purely educational is an adorable misconception on par with believing foxes teach chickens about security. These courses are marketed as benevolent outreach programs, an attempt to elevate public understanding of money, yet half the content subtly funnels attendees toward products the bank coincidentally sells. The advice is always technically correct, but strategically incomplete, like teaching someone how to navigate a forest without mentioning the wolves sponsored by the institution. Banks adore the myth because it positions them as wise mentors rather than profit-driven entities. People leave believing they've been empowered, unaware that the curriculum was curated with the same loving bias as a restaurant server who only recommends dishes with the highest markup. It's not education, it's financial theater disguised as community service, and the applause comes in the form of new account signups. 23. The belief that banking apps protect your privacy deserves a small trophy for unintentional comedy. The apps certainly protect you from accessing your own account without navigating authentication steps that feel like a spy thriller, but the information behind the scenes often flows freely to third-party analytics firms. People cling to the privacy myth because it comes wrapped in reassuring words like encryption and security. Yet the actual data ecosystem resembles a crowded marketplace where vendors are very interested in your spending habits. Banks maintain the narrative because acknowledging the truth would encourage customers to rethink the convenience of having every purchase logged with forensic precision. The irony is exquisite. The technology designed to hide your identity from hackers does a spectacular job while simultaneously compiling enough behavioral data to predict your snack cravings. Privacy exists technically, but only if you define privacy as safe from criminals but extremely visible to corporations wearing digital camouflage. 24. The myth that inflation is a natural phenomenon, like rain or seasonal allergies, ignores the far more entertaining explanation that it's often fueled by corporate price hikes masquerading as economic necessity. Banks eagerly support the myth because it frames inflation as an unpredictable force no one can control, rather than a series of choices made by companies enjoying record profits. People are told to cut spending and tighten belts, as if the average consumer single-handedly raised the cost of eggs through reckless behavior. Meanwhile, institutions discuss inflation like meteorologists analyzing storm patterns, offering vague forecasts while quietly benefiting from interest rate increases. The myth persists because it blames the public instead of the entities shaping the economy. Banks adore this framing because it absolves them of responsibility while positioning themselves as guides through the chaos they profit from with the rhythm of a metronome. 25. The comforting belief that banks keep safety deposit boxes 100% secure has the same energy as believing raccoons will respect a locked trash can. Safety deposit boxes are indeed sturdy, but not immune to break-ins, floods, fires, or clerical errors that occasionally result in employees opening the wrong box with all the chaos of someone rummaging through a thrift store bin. Banks love this myth because it allows them to charge annual fees for storage that resembles a glorified metal drawer. The boxes are shielded by layers of ritual, signatures, keys, privacy rooms, all designed to create the illusion of impenetrability. Yet history is full of boxes lost, misplaced, or mysteriously damaged, often followed by the bank politely explaining they technically assume no liability. It's a brilliant setup. Customers pay for peace of mind while the institution enjoys the luxury of disclaiming responsibility with the elegance of a magician, revealing that the rabbit was never in the hat. 26. The belief that banks are neutral institutions, calm, impartial guardians of capital, is one of society's most enduring comedic performances. These organizations claim neutrality the same way a referee insists fairness while wearing one team's jersey. Banks routinely lobby for regulations that benefit themselves, shape policy debates, and influence markets with the subtlety of an elephant performing ballet. Yet the myth of neutrality persists because institutions speak in monotone legalese that makes even their most self-serving decisions sound like procedural housekeeping. People imagine banks as stoic pillars of economic order, when in reality they behave like political creatures with exceptional accountants. The myth endures because confronting the truth would require acknowledging that the financial world is less an impartial system and more a buffet where the largest players reserve the best dishes before the doors even open. Neutrality is merely the costume. The performance beneath is unmistakably strategic. 27. The old belief that credit card points are a generous reward rather than a meticulously engineered behavioral trap remains a masterpiece of psychological manipulation. Banks present points as free gifts, little digital treats sprinkled across your spending, encouraging swipes the way casinos encourage button presses. The math behind reward systems is designed with the precision of a watchmaker, ensuring the points you earn are far less valuable than the interest payments you're tempted to incur. People imagine themselves collecting points for exotic vacations, unaware that it may require spending enough to fund a small moon landing. Banks adore the myth because it creates the illusion of empowerment, while luring customers into debt cycles that generate far more profit than the occasional discounted flight. Points aren't rewards. They're breadcrumbs leading consumers through a financial maze where the exit door is located behind a very expensive curtain. 28. The belief that banks protect your deposits no matter what glosses over the small detail that deposit insurance has limits, and those limits are sometimes exceeded faster than popcorn disappears in a movie theater. Banks rely on the myth because it keeps customers calm, avoiding the inconvenient chaos of mass withdrawals. The insurance exists, absolutely, but the assumption that it covers every scenario is a charming misunderstanding with all the durability of a paper umbrella. When institutions fail spectacularly, governments often intervene, but not because the system guarantees it, because letting the alternative play out would resemble a live-action disaster film. Banks encourage confidence because confidence keeps deposits stable enough to maintain lending operations. It's a delicate ecosystem. Customers believe they're fully protected, and banks benefit from a serenity built on selective truth. It's not dishonesty, it's optimism, with a legal disclaimer. 29. The illusion that student loans are good debt survives with the persistence of a weed growing through concrete. Banks and financial institutions promote this idea through glossy brochures showing smiling students tossing graduation caps, never mentioning the decades-long repayment schedule lurking beneath the confetti. The phrase good debt implies investment, stability, and opportunity, while the reality often resembles dragging a financial anvil long after the enthusiasm of academia fades. Banks adore the myth because student loans come with long horizons, consistent payments, and borrowers conditioned to treat their obligation as a rite of passage rather than a burdensome financial anchor. The myth is powerful because it mixes aspiration with obligation, a combination that feels noble until the first repayment notice arrives with the sharpness of a plot twist. Good debt is a comforting slogan, one that conveniently forgets the weight attached. 30. The idea that currency value reflects a nation's strength is a wonderfully simplistic myth, beloved by bankers who appreciate tidy narratives. People imagine currencies as gladiators battling in an arena, with strong economies producing mighty monetary warriors. The truth is closer to a chaotic talent show, where judges include global investors, political drama, trade imbalances, and the occasional unexpected scandal. Banks encourage the myth because it offers a clean explanation for fluctuations, diverting attention from the layers of speculation and manipulation that often guide currency markets. The narrative allows institutions to frame depreciation as weakness and appreciation as glory. even when shifts are caused by nothing more than an interest rate rumor whispered by someone with a microphone. Currency value isn't a reflection of national virtue. It's a soap opera broadcast in economic time. But the myth? It sells beautifully. 31. The cherished belief that wealth naturally trickles down has survived through pure theatrical audacity. The financial version of insisting a broken vending machine will eventually produce snacks if everyone just believes hard enough. Banks and corporations support the myth because it portrays inequality as temporary and generosity as inevitable, as though capital is a magical river destined to flow from penthouses to studio apartments. In reality, wealth behaves less like water and more like a stubborn boulder, immovable without external force. The myth survives because it's comforting, offering hope that prosperity is merely delayed rather than structurally rerouted. Banks rely on the narrative because it discourages scrutiny, urging people to be patient while the financial system quietly funnels value upward with the efficiency of a vacuum cleaner sold on late-night TV. The performance is impressive. The results are unmistakably one-directional. And that's the financial circus for today: greed, confusion, and math crimes. Drop your favorite ridiculous money myth in the comments and vote for the dumbest. Like, subscribe, and brace for the next disaster.